Sunil Subramaniam and chat about where he feels the market is headed. Sunil, hi, morning. It's almost consensus that we are, at the cusp of another great move by the market. But right now, since there is that overhang of elections and impending one at that, I guess you got to ask yourself whether do you buy in afresh at this current juncture of the rally, or would you now say that let me profit take a bit because the market has elevated itself?
So I would say that you need to do both. I think where you will buy will be cyclicals, because I think what's happened is that they are been correcting so long and so hard that I think this is a good time to step in and do fresh buying in cyclicals, because I think Indian economy is on a growth path. 8%, 7.5, all these are quibbles. You're still way above the rest of the pack. Second is profit booking can happen in those sectors which rallied over the last 1 year because of rupee weakness, oil weakness, like IT, pharma, right? I think there can remain part of your portfolio, but some amount of profit booking is not bad, because the way forward, because rupee is in our view going to be stable, because the US is having both the twin deficits under pressure. Oil for India, which is a key rupee factor, is also I think going to trade not below 70 to 75 band max. So Indian rupee is looking decent in the coming year. Because of that, IT and pharma, which had the benefit of a strong dollar and weak rupee, will not see the same impact. And H1B things are also pushing up costs for the IT sector. So we believe the top line growth of IT will be decent, but the bottom line will get impacted for these two factors. So I would say some kind of profit booking, if you want to do, would be in these export or stroke services export oriented sectors, but they should still remain a part of your portfolio. I wouldn't say entire book can walk out. So I think they are a safety element to the whole.
It's interesting you say that, because a lot of the voices that we've had recently have still preferred to stick to what you could call the safer names, or the the known value picks in the market, growth picks rather. But do you think it's time to perhaps shuffle the basket a little bit, get a few of the mid-cap, small-caps in that perhaps one hasn't looked at recently, given that they've been so beaten down and are perhaps now available at better valuations?
Absolutely. So about a month to 3 months ago, we were talking about 60% large cap, 40% mid-cap. Today I'm close to 55-45 in terms of how the allocation should be. So mid-caps have gone up from about 30-35 to 45%.
And
so
you
I think
said it would be higher if you're looking at a longer time frame as
absolutely.
well? Yeah.
Because I'm talking about from a 12-18 month kind of perspective. If you take a 3 to 5 year perspective, clearly I think mid-cap should be 65-70% of your portfolio. You're at what? Forward PE of 12.5 to 13. And our mid-cap, small-cap funds, the stocks that we are holding, the next 3 years CAGR is 25% EPS growth projection. So we are getting them at very good valuations, but intermittent volatility will be there. So if you have a clear 3 year perspective and say, okay, I'm not worried about intermediate, they are going to be your multi-baggers. And I think this is a clear time to shift that portfolio from that perspective.
So say someone's watching right now, they heard that bit of advice for you. I'm not going to probe on stocks, but what are you finding interesting by way of themes? You've been talking about banks and consumption.
So basically for us, see, consumption as a theme is very important from the economy perspective. So I would separate consumption as a stock sector theme, because there you have individual place at hand, right? And you also have the overhang that NBFCs are not lending. So, consumer durables are financed, right? But consumption is strongly growing, and the impact of that is two things. One, GDP growth is going to be dependent on consumption. Second, rural growth is going to be dependent on consumption. But most importantly, capacity utilization in many sectors are going up because of the consumption boom. So for me, consumption is the lead indicator that the capex cycle is not very far away, and overall capacity utilization around 76-77% today. But there are lots of sectors, right, cement, steel, where it's on upwards of 80. So as this reaches close to 85-90, you'll see fresh capacity creation happening. And so EPC contractors, construction companies, cap goods suppliers, they are the bets where there's a good valuation come future growth story at play.
So you've been talking so much about auto as well, and I'm curious, because right now we're seeing so much pain across the sector. When you're so bullish on the story going ahead, do you see that transmitting to the auto space as well, and how soon? Because right now we're just not seeing any signs of that kind of recovery or of any kind of relief for the sector.
Correct. So as part of discretionary consumption, we've been very bullish on auto for forever. Okay, what has happened there is that the NBFC crisis has had an impact on the auto demand because all two-wheelers, cars, everything is finance purchase and NBFC is being absent. So as a result, the inventory build-up in the auto segment combined with the fact that significant proportion of auto input costs are import related, right? So the dollar's strength and the crude impact hit their margins. So that's why you led to a situation where the expected valuations were turned out to be rich. And today you're seeing auto companies cut production so that their excess. But like I just explained, this quarter, March end, we'll see a huge buying pickup because of depreciation related buying. And the first quarter next year, so I'd say give it 2 quarters. Where you can be a little bit neutral on auto for the next 2 quarters, and then you see auto as part of the consumption pack again pick up. So I would say there's a slight pause in that story because probably there was overhype and over anticipation that this boom is like, you know, great. There was a small pause because of these factors, but it's only a matter of 2 quarters. After that we are back in.
Okay, you think crude could be a little tricky because, you know, none of us have talked about it or even realized because we've been so happy to seeing the Nifty levels and the broader market recovery. But crude is already at a 2019 high. We're already standing at $67 per barrel on Brent.
We think we are protected till 70, 75 as a country. So if I see any trends going beyond 75, then I would start to get worried. But as long as it's trading up to $75, I'm fine with crude. I think the market, the stocks, the companies have all factored in this kind of a pricing. So if it remains around this, I think it's okay.
You know, we were chatting with Rhythm Desai a short while ago, and he was just talking about, you know, discussion on how he's surprised that everyone's spending so much time on the election outcome. From a market standpoint, we have seen perception change overall, be it, you know, FII views, etc., based on a predictable election outcome. But from a market standpoint, how much do you think this event is going to be looked at?
I think the elections have generally proved to be a distraction for the market. Okay, we studied the last 3 elections, and 2004, 2009, 2014, 6 months from the voting day, 1 year return of the Nifty was 35%, 35% and 16%. So we believe that the elections impact, people are human beings in the market, telling them this is a distraction doesn't work. But the facts prove that this. So I think that they say, you know, fools rush in where angels fear to tread, right? I think the elections are a classic case where you are overcome with that kind of fear of what if this government doesn't come back, does all this get set back? And as a human, you are a victim of that. But if you stay calm and cool, right, I think the underlying strength of the Indian economy, right, I don't think is at all matters with the election. I think politics and economics have got disconnected to a large extent. So I think I agree that elections are just a distraction, and one should ideally as a long-term investor not worry and keep to your longer-term outlook. But we all know that people are human, they will do their actions and reactions.
Okay, Sunil, great to have you on the show. Thank you so much for taking the time out.